Most developers approach the capital stack the same way. They model the total proceeds, rank the options by headline cost, and pick the one that looks most efficient on paper. Then they get to the lender conversations and find out the structure they chose is not permitted, not bankable, or not something their institutional LPs will accept. This is an expensive lesson on a $10 million plus deal. The real question in 2026 is not whether gap capital is available. According to the Mortgage Bankers Association, commercial and multifamily mortgage originations are projected to rise 27% in 2026 to roughly $805 billion. Capital is returning, but the Federal Reserve Senior Loan Officer Opinion Survey showed only modest easing in CRE lending standards through late 2025. Underwriting is still selective. The margin for structural mistakes is narrow. Now, this video in IRC Partners Stack is on structuring the capital stack for $10 million deals or more. The hub covers the full sequencing framework, so this spoke focuses entirely on one decision: which layer, senior debt, mezzanine debt, or preferred equity, is actually the right fit for your specific gap. So by the end of this video, you'll be able to identify which layer your senior lender will and will not permit. Compare the real costs of each instrument beyond headline pricing. Choose the structure that protects execution certainty, not just maximum proceeds. Where each layer actually sits in the capital stack before comparing instruments, you need to know where each one lives legally, not just financially. Positioning in the stack determines payment priority, default remedies, and what your senior lender will tolerate sitting behind them. Senior debt, first lien position, secured by a mortgage on the property, paid first, used as primary construction or acquisition financing. Mezzanine debt, behind senior, ahead of equity, secured by a pledge of ownership interest through a UCC filing. Paid after senior, used as a gap financing where the senior lender permits subordinate debt. Preferred equity, equity layer above common equity, secured through operating agreement rights in the LLC. Paid after all debt, used as gap financing where agency or bank lender restricts additional debt. The legal distinction between mezzanine and preferred equity is not cosmetic. Mezzanine debt is secured by a pledge of 100% of the equity interest in the borrowing entity, giving the lender UCC foreclosure rights. Preferred equity holds no lien on the property and no UCC filing. Instead, it relies on provisions in the LLC operating agreement. That difference changes everything: lender approval requirements, intercreditor obligations, cure rights, and how fast a lender can act if the deal goes sideways. The label matters less than the legal position. The practical comparison framework: cost control, lender tolerance, and LP impact headline pricing is the first thing sponsors look to and often the least useful variable for making this decision. Here's how the three layers compare across the dimensions that actually determine whether a deal closes cleanly. Typical costs: senior debt is the lowest, SOFR plus spread. Mezzanine debt runs 10 to 15% all in. Preferred equity runs 8 to 15% preferred return, often higher all in with accrual and participation. Current pay burden: mezzanine debt requires fixed obligations. Preferred equity sometimes defers or accrues, making it more flexible. Senior lender approval: not applicable for senior debt, required for mezzanine and often restricted or prohibited. Preferred equity is usually more acceptable to banks and agencies. Intercreditor complexity: low for senior debt, high for mezzanine, requiring a negotiated intercreditor agreement. Low to moderate for preferred equity with no formal intercreditor agreement with the senior lender. Default remedies: senior debt uses mortgage foreclosure. Mezzanine uses UCC sale in 30 to 90 days. Preferred equity uses negotiated control rights via the operating agreement. LP optics: senior debt is clean, mezzanine is acceptable if well structured. Preferred equity raises governance questions if not explained clearly. Prepayment flexibility: senior debt varies. Mezzanine is usually coterminous with the other senior loan. Preferred equity can often be repaid independently of the senior loan. Hidden costs sponsors miss. Headline rate comparisons miss the real cost of each layer. Before choosing, model these. Intercreditor legal fees: mezzanine requires a negotiated intercreditor agreement with the senior lender. On a $10 million or more deal, this can add significant significant legal costs and weeks to timeline. Accrual and compounding. Preferred equity with deferred current pay can look cheaper upfront but compounds quietly. Model the exit distribution, not just the stated rate. Governance and consent rights. Preferred equity providers often negotiate consent rights over major decisions, capital calls, or disposition. This affects sponsor control and LP waterfall. Coterminous risk. Mezzanine loans typically mature when the senior loan matures. If the senior loan does not extend, the mezz does not either. That is a refinancing constraint most sponsors underestimate. LP perception. Institutional LPs reviewing a deal memo will scrutinize the subordinate layer. A preferred equity provider with aggressive control rights can raise red flags in LP diligence, even if the economics look fine. The bottom line, mezzanine is often cheaper on paper but carries more structural friction. Preferred equity trades some economics for lender compatibility and current pay flexibility. Neither is automatically better. The right answer depends on what your senior lender will allow, what your cash flow can carry, and what your LPs will accept. Senior lender reality. Why your lender often makes this choice for you. Sponsors think they're choosing between mezzanine and preferred equity. In many cases, that senior lender has already made the choice for you. Agency lenders, Fannie Mae, Freddie Mac, and similar programs typically prohibit mezzanine debt outright. Bank construction lenders are more varied, but many restrict or require consent for any subordinate debt layer. Most banks prefer preferred equity over mezzanine because mezzanine can be treated as an additional debt layer under HVCRE regulations, which complicates their regulatory capital treatment. The real risk, sponsors who assume mezzanine is available without confirming it in writing often discover the conflict after term sheets are signed. Rebuilding the structure at that stage costs time, legal fees, and sometimes the deal. 5 questions to ask before choosing a layer. Ask these before approaching any subordinate capital provider. Number 1, does my senior loan agreement explicitly permit subordinate debt? Get the answer in writing from your lender, not just verbal confirmation. Number 2, is my senior lender an agency program? If yes, mezzanine is likely off the table. Preferred equity is the practical starting point. Number 3, what is the senior lender's DSCR minimum, and can my cash flow support an additional fixed payment layer? Mezzanine adds a mandatory cash obligation. Model the combined debt service before committing. Number 4, will the senior lender negotiate an intercreditor agreement with a mezzanine lender? Some lenders allow mezz in principle but impose intercreditor terms so restrictive that mezz providers will not accept them. Number 5, how will this layer read in LP due diligence? Institutional LPs will ask about subordinate capital. Know how the structure looks before you have to explain in a capital call memo. Understanding the answers to these questions is part of what IRC Partners addresses before any capital outreach begins. When mezzanine debt is the right answer, and when preferred equity wins once you know what your senior lender permits. The selection comes down to 4 variables: cash flow predictability, hold period, sponsor control priorities, and LP composition. Now here's how to apply them. Choose mezzanine debt when the senior lender has confirmed in writing that subordinate debt's permitted. The project generates stable, predictable cash flow that can cover fixed mezz payments. The hold period is short, 2 to 3 years, and coterminous maturity is not a risk. Preserving sponsor upside matters more than structural flexibility. The deal does not involve agency financing. Choose preferred equity when the senior lender is an agency program or has restricted subordinate debt. Cash flow is variable or deferred, such as ground-up construction or heavy value add. Current pay flexibility matters more than preserving every basis point of sponsor upside. The sponsor can absorb governance or consent rights in exchange for lender alignment. The hold period is longer and independent repayment flexibility has value. If this, then that. Here's the scenario. Agency senior loan, gap needed. Right layer, preferred equity. Mezz is provided. Here's a scenario. Banked senior loan, stable income property. Right layer is mezzanine, if permitted and confirming in writing. Scenarios: ground-up construction, no current cash flow. The right layer, preferred equity with accrual structure. Scenario: short hold, long DSCR, bank lender. Right layer, mezzanine, if intercreditor is negotiable. Institutional LPs with governance sensitivity. The right layer, preferred equity with clean operating agreement rights. Scenario: refinancing shortfall, existing senior loan stays. The right layer, preferred equity, which can often be repaid independently. Private real estate debt funds raised $51 billion in 2025 and captured 31% of private real estate commitments, according to Fidelity Institutional Research, reflecting how much institutional capital has moved into this space. And that means providers exist for both instruments. The constraint is almost never availability, it's fit. Proof point one IRC partner's engagement where layer selection mattered engagement. Capital Advisor, multifamily development, Texas, $150 million total capitalization. The challenge, the developer had identified a gap in the capital stack and was approaching mezzanine providers based on headline pricing. The senior construction lender had not been formally consulted on subordinate debt. The deal had institutional LP involvement and ground-up business plan with no current cash flow during the construction phase. The decision, IRC Partners' role, was to pressure test the proposed structure before outreach began. The senior lender's loan documents restricted subordinate debt without prior written consent, and the lender indicated that consent would not be granted for a mezzanine instrument given HVCRE exposure concerns. The structure was repositioned around preferred equity with an accrual feature aligned to the construction timeline, eliminating the intercreditor conflict and reducing documentation friction with the senior lender. The implication? The deal did not need a different capital source. It needed the right instrument for the lender relationship and business plan already in place. Choosing the wrong layer first would have required rebuilding the structure after term sheets were in motion. Layer selection happened before outreach, not after. IRC Partners structures the deal before going to market. And that sequencing is the difference between a clean raise and a delayed one. What developers should do next before lender outreach? What developers should do next before lender outreach capital is available in 2026? The issue is whether your structure can actually close under the constraints your senior lender LPs and timeline will impose. Before approaching any subordinate capital provider, work through this checklist. Pre-outreach structure checklist, confirm in writing whether your senior lender permits subordinate debt. Identify whether your senior loan is agency or bank. This narrows the menu immediately. Model combined DSCR under both mezzanine with fixed current pay and preferred equity with accrual scenarios. Map the governance and consent rights a preferred equity provider is likely to require and assess LP tolerance. Review coterminous maturity risk if mezzanine is on the table. Confirm how the subordinate layer will be presented in LP deal memos and subscription documents. If you want to get the layer selection right before term sheets are in play, the link is in the description below. IRC Partners works with seasoned developers raising $10 million to $250 million or more to pressure test capital stack structure before going to market. So book a strategy call with IRC Partners now to get the layer selection right before term sheets are in play. Frequently asked questions. What's the difference between mezzanine debt and preferred equity in real estate? Mezzanine debt is a loan secured by a pledge of ownership interest in the borrowing entity, giving the lender UCC foreclosure rights. Preferred equity is an equity investment in the property holding LLC with rights governed by the operating agreement. The legal distinction determines lender approval requirements, foreclosure speed, and intercreditor obligations. Both sit between senior debt and common equity in the stack, but banks often prefer preferred equity over mezzanine for regulatory reasons, which has made it the more common gap-filling instrument in bank-led construction structures. Can I use mezzanine debt with an agency loan? Generally, no. Fannie Mae, Freddie Mac, and most agency programs prohibit subordinate debt by explicit loan document language. This is not a negotiation position, it's a hard restriction. Agency lenders require minimum equity percentages. Mezzanine does not count as equity, and the foreclosure rights a mezz lender holds create control conflicts agencies simply will not accept. If your senior loan is agency-backed, preferred equity is the only practical subordinate capital option. Confirm your senior loan program before approaching any gap capital provider. Which is cheaper, mezzanine debt or preferred equity? Mezzanine debt typically runs 10 to 15% all in. Preferred equity returns often range from 8 to 15%, but the all-in cost can be higher once accrual, participation, and deferred return compounding are modeled. Most developers make the mistake of comparing stated rates when they should be comparing exit economics. Model the full distribution at exit under both structures before choosing based on headline pricing. What is an intercreditor agreement and why does it matter for mezzanine debt? An intercreditor agreement is the contract between the senior lender and the mezzanine lender that defines payment priority, cure rights, standstill periods, and enforcement controls. Negotiating it adds legal costs and weeks to closing. Some senior lenders impose intercreditor terms so restrictive that mezzanine providers will not accept them, effectively killing the mezzanine option even when the senior lender technically permits it. This is the hidden friction most developers discover too late. Confirm intercreditor terms before you commit to a mezzanine structure, not after. How does preferred equity affect my LP waterfall? Preferred equity sits ahead of common equity in distributions. If the preferred provider negotiates participation rights or a promoted interest on top of the preferred return, it reduces LP returns before the GP promote is even calculated. Institutional LPs will scrutinize these terms in due diligence. A structure that looks clean on summary sheet can look very different when the preferred equity terms are modeled at exit. Structure and disclose it clearly in LP deal memos before the subscription process begins. What loan-to-cost ratios should I expect from senior construction lenders in 2026? Most bank construction lenders are currently underwriting senior debt at 50 to 65% LTC for ground-up development, down from the 65% plus levels common before 2022. Agency lenders remain active in multifamily and are pricing 7-year debt in the 6.5 to 7% range. Bridge and construction lending for value add or development plays run 8.5 to 10%. Developers who build their stack around pre-2022 LTC assumptions will face a gap they are not prepared to fill. When should I use senior debt alone without any subordinate layer? When senior proceeds are sufficient to fund the deal and adding subordinate capital would create cash flow stress without a proportionate benefit. Adding leverage for its own sake increases downside risk without improving execution certainty. If your senior lender can cover the full capital need at a DSCR your business plan can support, the cleanest structure is usually the right one. Subordinate layers should solve a real gap, not optimize for maximum proceeds on paper. Be sure to schedule your call in the description below if you're looking for $5 million or more of institutional capital. We can hop on a call and discuss your needs. Stay tuned for the next video.